So today is Monday, September 28th. This is the end of day review for the live trading room. We're talking about the adaptive entry system signals that present a pretty amazing opportunity for almost any trader to trade. Now, we profile the adaptive entry system method on the NASDAQ 100 futures using a 5-minute chart. But don't get restricted to that because the adaptive entry system is very adaptive. You can use it on 1-minute charts, 3-minute charts, 10-minute charts, 30-minute charts. You can trade any future commodity you choose and use the same signal methodology. You could trade options on stocks. You could trade options on cash indexes. You could trade options on ETFs. Bottom line is there's a common denominator amongst any and all methods that you may choose to trade, and that is the adaptive entry system. You've got 4 basic signals. You've got the trend bias signal that tells you we are likely going to begin a trend. In this case, it was a rising trend. Back here, we had a trend bias indication telling us we're likely going to begin a declining trend. And you can see that an entire cycle, an entire day involves cycles of declining trends, some neutral zones, another declining, some rising trends, declining, rising, etc. Okay. In addition to the trend bias, we have continuation trades, we have consensus signals, and we have momentum signals. All of these are defined for you in the adaptive entry system training, and we talk about them throughout the day in our live trading room. The very simple approach that we have designed into this, we being New Cycle Trading and Options Moneymaker collaborated in the creation of this, is we show you a vertical green or vertical red line. Vertical green means go long, so buy to open a call if you're trading options, go long on a futures. Vertical red says buy to open a put if you're trading options, go short on futures. It's really that simple. Now the labels help you understand what method is being interpreted, but you really could just simply trade go long on a green and go short on a red. We've tried to almost oversimplify it so that the aspect of understanding technical signals is no longer the most complicated thing that most traders have to encounter. We've made it ultra simple. All right, so what we do at this part of the day, end of day, is we do a quick review of all of the trades. So those of you who like to take a screenshot of from 7 o'clock on, and we cut off today at 5:30. Actually, the last one was 5:31. That was a fractal trade. So we start by doing a review of what our performance was for the day. And there's 2 primary categories that we break it down into. And what we're going to do is we're going to take our performance for the day and we're going to input our results for the day into the personal trading plan. And the personal trading plan was designed for you to help do a full 12-month, 52-week financial forecast for your business, meaning your ability to generate profits and what those gross profits are going to be after fees and commissions. It doesn't take into account your monthly expenses of participating in the live trading room or for the adaptive entry system, but you can actually add those into the plan. But I'm going to show you a very basic way to use this. All right, so the 2 categories that we monitor on an everyday basis are trading from 9:30 a.m. Eastern to noon and taking all of the signals. So those are the 4 signals that I just mentioned. Now, in addition to this, we also track fractals, and fractals offer us an additional opportunity for potentially more trades, and sometimes they help significantly, and other times they just kind of flatten out and they're no real additional value, but they give us a opportunity to take yet additional signals in addition to the 4 signals that we're talking about. The other category that we track is from 7 a.m. to 4 p.m., taking only the trend bias trades as well as the continuation trades. And then we do highlight another category which we have identified in the last few weeks as kind of our optimum performing category in terms of point production, and that is from 7 to 4 all signals. So here we have 9:30 to noon all signals. Here we have 7 to 4, just 2 signals, the trend bias and the continuation. And then here we have 7 to 4 all signals. So in our 9:30 to noon category, we lost 50 points today. So that was a pretty heavy down day today. And that's because we had a few trades this morning that we had full stop outs on. This afternoon was a little easier, and even before 9:30 was a little easier. We only finished down 18.25 points. And if we had taken all signals 7 to 4, we only finished down 8 points. So that's really not significant in my opinion, but let's move beyond opinion and let's just talk facts. So in the all category, let me just jump back here. In the all signals category, 9:30 to noon, we did 50 points negative, 50, and we had 13 trades, and then we had 18.25 points negative in the 7 to 4, and we did 16 trades. All right, so let me show you, if you're brand new to this, how we're going to translate that into our trading plan. Okay, so here's our personal trading plan, and we're looking at the 9:30 to noon category. This is for the live trading room, all signals. The blue shaded area are all of the days that are behind us. We're about 12 weeks into this now. This is a 52-week plan, so we've got 40 weeks to go. And so we're going to go here to Monday, September 28th. We're going to scroll over to our data entry area, and we know that we lost 50 points. Now each point on the NASDAQ 100 is worth $20. So 50 times 20, so we're down $1,000, and we're trading 3 contracts. I'll explain more about contracts here in just a minute. So we put in a minus $3,000. And we wait. Okay, hold on just a second. Minus $3,000. Okay, there we go. And we did 13 trades at 3 contracts per trade, so we have 39 contracts. All right, so we're going to lock that in, put a contract override of 3. All right, so now the important work that we need to do is to come up here to the top. We've got 4 numbers showing up here. This number is telling us that we have now 12.2 weeks under our belt. This number is telling me that we have had 21 losing days out of 12 weeks, so 12.2 weeks. This number is telling me of all of my winning days what my average is, meaning the average point production per winning day, and so that's based on $20 a point. And then this is my average losing day. So if I take all of my losing days, they average out to 34.87. Now both of these numbers are influenced by one other thing. The plan, when you start with a brand new 12-month, 52-week plan, the plan assumes that you're going to have a loss approximately once every 5 days. 1 out of every 5 days is going to be a losing day. So the plan is based on that. And so if we exceed that occurrence, that frequency rate, then these averages are going to be adjusted. They're automatically adjusted according to the frequency of losing days versus the planned losing days. So we don't really have to do a lot there. We just take those numbers. We know that that's what we are averaging right now. We're averaging these numbers in both the win and loss category, and we know that we're slightly ahead of plan in terms of the frequency of losing days. So how does that affect us? What we're going to keep an eye on is this number right here, $187,464. That prior to today was the 12-month forecast of income that we could possibly see based on having started with $5,000 in the account. So what we want to do in these two categories right here, this line 5 and line 6, is we want to now plan our go forward forecast. Remember, we've got about 12 weeks behind us, which means we've got about 40 weeks in front of us. And so how are we going to plan effectively for the rest of the 40 weeks? Okay. Well, we want to be as close as our run rate as possible in terms of our forecast. So I'm going to take that 23.16, and I'll put it in my winning day average forecast for the rest of the 52 weeks. And I'm going to take the 34.87 and I'm going to put it in the losing day forecast, minus 34.87. Okay. And those numbers now take into account the fact that we have a slightly greater than original planned frequency of losses. Okay, so you could talk about this in a variety of ways, and if you look at it as subsets of data, you could start to interpret all sorts of things and actually make up stories that are not true. So we could say, oh look, you know, we were only supposed to be we're only supposed to have 12 losing days in 12 weeks and we're at 21 days. Oh my God, this isn't working. And you know, you could tell yourself all sorts of stories, but that's just not valid. All we are doing with the trading plan is presenting to you a mathematical accumulation of profits and losses and projecting out going forward, saying if we could continue to achieve the same run rate that we have already achieved, then this is our potential income over 12 months if we can continue that same run rate. So that run rate takes into account the fact that we've actually got 9 extra losing days in 12 weeks. Well, you could look at that as glass half full, glass half empty, and I look at it as glass is almost full, not just half full, because we've got $174,828 potential 12-month income, having started with just $5,000. Now, it's less than it was when we updated this based on Friday's numbers, but it is the reality of where we are right now. But now let me show you one of the really cool things about this trading plan. If you're not familiar with this, we start with $5,000. Each contract that we trade in the NASDAQ 100 requires $500 a margin. $500 a margin. That's what the broker requires in order for you to participate, play in the game, and put on an active trade. You know, open a position with one contract. So what we've done is we've designed our trading plan to say $500 a margin, but I will only trade a number of contracts where the total margin requirement is less than 10%, which I set over here, of the balance of my account. So for me to be trading 3 contracts requires $1,500 a margin. $1,500 a margin is 10% of 15,000. I need 15,000 or more in the account before my trading plan will graduate me up to 3 contracts. If I scroll back here, you can see we started with 1 contract back on July 6th. Then it scaled us up to 2 contracts because of the growth of the account. And then we've been at 3 contracts ever since Friday, the week of July 20th. Okay, so we're at 3 contracts. I'm now in control of how many contracts I want to trade, because the number of contracts will never grow beyond a margin requirement of more than 10% of the balance of the account. So knowing that, I can put in whatever number of contracts I want, and the trading plan will allow me to scale according to being less than 10%. So I've got it set at 3 contracts. Well, what if I decided I'm really comfortable with what I'm doing? I'm confident in my understanding. I understand I have 9 more losing days than I originally planned, but now that's baked into my run rate. I know all of this, and so what if I said I'm willing to trade up to a maximum of 5 contracts? Well, all of a sudden, your potential income goes up by about $90,000 over the course of 12 months. What if you decided you were really comfortable and you're willing to trade up to 10 contracts? Well, that's a significant difference from the forecast that we have at 3 contracts. And this is all individual trader discretion. You're not going to get up to 10 contracts until the balance of your account is such that 10% of the balance of your account is sufficient to cover the margin requirement on 10 contracts. But prior to that, it's going to scale you up to 6, 7, 8, 9. You know, it's going to just mathematically tell you, here's the answer according to the parameters that you built into the trading plan. So I'm going to leave that at 3 because I think that's a very reasonable number based on having started with $5,000. I know that I could earn more if I chose to by increasing the number of contracts. I also know that everything that I built in here is based on run rate that is realistic because I've got 12 weeks behind me, I've got 40 weeks in front of me, and the 40 weeks in front of me are all going to be based on the current year-to-date run rate. All right, so let's jump over to the other category where we track the 7 to 4 trend bias and trend consensus signal, trend continuation signals only. Okay, we lost 18.25 points, and that's $20 a point. And we're trading 3 contracts, so we had a loss of 1,095 today. And we did 16 trades, 16 times 3 contracts each, so we have 48 contracts. So that contract number takes into account then the cost of doing these trades, commissions, fees, exchange fees, etc. All right, we're going to do the same thing now. Here, we've got 12.2 weeks behind us. We've had 14 losing days in 12.2, so slightly ahead of plan, which should only be 12 days, but not as far ahead of our losing trading plan as the other category. Okay, our winning day average takes the slight variation to frequency of losing days into account. Our losing day average does the same. So I'm going to update these now for go forward forecast, 33.41 and minus 27.77. So now my forecast for 12 months in this category is $324,881. Okay, and if you feel comfortable with that, and you feel comfortable with your run rate, and you feel confident in how you got here, it wasn't just a luck and a prayer. It was diligent trading and understanding of why you took those trades, what those signals did, when you should tighten up your stop, how you should protect yourself, and the overall result is this average that you see. Then you could play around with your maximum number of contracts. So you could say 5 contracts, okay? You could get close to $500,000. Maybe you're ultra conservative and you don't want to trade more than 2 contracts, and that run rate could possibly get you to a number that's just under $240,000. So again, I think 3 is a very conservative, reasonable number. You can scale to whatever you choose. One of the reasons that we have the 10% limiter in there is because you could put in, let's just say, 100 contracts. You put 100 contracts in here, max, and you can see how it would scale up to 100 contracts, but it's not going to get there until you have a sufficient balance in the account to cover the margin requirement on 100 contracts. Now on NQ, I'll just say I don't think 100 contracts is practical for most people to trade. I'm just demonstrating you the math of the compounding that is possible, and once you feel 100% confident with the limiter level number 1 on your risk and capital allocation, then limiter level number 2 can be whatever you choose it to be, whatever you're most comfortable with. Like I said, I think 100 contracts is too much to be reasonable, but there you go. You can play around with that all you want. Okay, one thing I wanted to just touch on, I haven't touched on before. I mentioned earlier that this is a financial forecast for your trading business, and just the basic way we approach it and show it here doesn't take into account your costs, like your other costs, but it can. In this field over here, column Q, funds plus or minus, on a monthly basis, whatever you're paying for support, for training and education, for subscription to the adaptive entry system, to the live trading room, whatever you pay on a monthly basis, you could plug the number in over there, and that will take that value into account. You plug it in as an expense, so minus number, and it will take into account your expenses, and then you truly are using this very, very simple tool that you would prepare and spend about 3 minutes a day on to do a full financial forecast for you for your trading business. It's really, really super simple. Okay, last thing I'll just touch on here is let's take a quick look at our averages. We're averaging on the all signals, 9:30 to noon, we're averaging $385.67 a day. That's assuming one contract. Now that's based on 75 trading days, and there's about 20 trading days per month. So 75 trading days, we're averaging 385. We lost today, but I look at the big picture averages because this is taking into account, you know, volatile days, slow days, big winning days, losing days. It's taking into account everything. And I think it's far more important to focus on the averages. So that's what I like to do. And the other category, the 7 to 4, taking the trend bias trades and trend continuation trades, we're averaging $612.73. My favorite category, because we've studied the data and we understand now that it is the optimum performing category, is all signals 7 a.m. to 4 p.m. We tend to cut off around 3:30, but 7 to 4, and the average is $1,353 a day. That's a pretty strong day. That right there, if you average that, even if you average this down here, 1 to 2 days a month is sufficient to cover your costs of your trading business. All right, so that's all I had to share with you today. I appreciate you being here. You know, even though today was a down day, we're kind of excited in most days because what I see as we develop more and more data and as we trade the adaptive entry system signals and we help you refine your understanding of how to trade them, it's kind of a no-brainer in my opinion. Winning days, losing days, winning trades, losing trades, net them all together. And if you truly could build yourself a plan where you could go from $5,000 to maybe $320,000 or maybe $5,000 to $175,000, and I think that those are fairly conservative because I'm holding the reins back at just 3 contracts max. I think that that's a pretty decent business right there. So thanks for being here, everybody. Really appreciate you following along, and please join us in the live trading room.